Is a financial shift about to happen? Bonds are known for their part in the renowned 60-40 investment model. But now there's talk about bonds being replaced by commodities, including gold and silver. Before we begin, remember to like this video and subscribe for more economic updates. In a recent analyst note, strategists at Bank of America declared the commodity bull market's just starting, adding that the commodities asset class is, quote, a better 40 than bonds in the 2020s. It's a stunning assessment that speaks volumes for the ways in which the economic environment has changed over the last several years. Analysts suggest the persistently higher inflation and higher interest rates that have characterized the years since the global health crisis have proven problematic for bonds, and that as a result, bonds have struggled to provide the portfolio diversification benefits for which they're known. On the other hand, commodities have, at times, been an especially effective hedge against inflation. The Labor Department notes that commodities make up nearly 36% of the Consumer Price Index, the nation's most prominent inflation gauge. As Bank of America analysts put it, the commodities secular bull market in the 2020s is just getting started, as debt, deficits, demographics, reverse globalization, AI, and net zero policies are all inflationary. The strategists point out that while the overall return on commodities has averaged between 10 and 14% since the beginning of the decade, 30-year U.S. Treasuries have declined roughly 40% over the past 4 years. 2022 was an especially bad year for the 60-40 portfolio mix, with both equities and bonds posting what BlackRock calls meaningfully negative returns. The performance of the benchmark 10-year U.S. Treasury note was especially noteworthy. Its double-digit percentage decline in 2022 was the worst calendar year performance since 1788. That same year, however, the Invesco DB Commodity Tracking ETF, a portfolio of 13 commodities, returned close to 20%. Another factor potentially in commodities' favor is the anticipated climate of heightened geopolitical risk expected to prevail. Geopolitical risk can have an inflationary impact on economies for a variety of reasons, including the triggering of supply chain disruptions. Geopolitical tensions can activate the perceived safe haven benefit of select commodities, including precious metals. On that note, analysts at UBS recently said, "We have held the view that commodities such as oil and gold remain potentially helpful geopolitical hedges." Bloomberg recently determined the metal has outperformed U.S. Treasuries over the last half-century, due in no small way to the vastly different performances of gold and bonds over the last several years. Reiterating Bloomberg's assessment, Christina Hooper, Chief Global Market Strategist at Invesco, recently noted, "The safe haven asset class of choice has become gold rather than treasuries." Throughout this year, we have been reporting on the increasing position of gold in unlikely places. First, the central banks, followed by big fund managers, then hedge funds, pension funds, and the list keeps growing. Now we're looking at financial institutions considering the possibility of including commodities in the standard portfolio mix. Whether they do or they don't, what's important is the movement into gold keeps growing. Could this be a big financial shift?